different components, right, of the cost of capital, right? And we talked about internal rate of return approach, something like this. Okay? So in case we are interested in coming up with the cost of debt, we could calculate this internal rate of return, right, using this formula. Okay? All right. And we talked about the couple of things we have to remember about this, the cost of debt. Okay? Well, what about the cost of preferred stock? Preferred stock, in essence, even though the name is stock, many times it is considered debt for financial analysis purpose. Okay? Because just like bond, once it is issued, the company is obligated to make the dividend payment, okay? Periodical dividend payment. Okay? Well, of course, the difference between the bond and the preferred stock is, if you miss any interest payment on bond, it will be devastating, right? The company's rating will be immediately changes to D, okay? In default status, right? And it will be the consequence will be quite terrible for the company, right? But for preferred stock, if the financial situation is not really good, company can skip the dividend payment for a quarter or two, right? But the missed dividends accumulate, right? So before you start paying any dividend on your common stock, you have to first pay all the accumulated dividends on the preferred stock, right? So, ultimately there is no difference. I mean, it just like the debt instrument, the company is obligated to make the payment, right? The dividend payments to investors, okay? But at least you can earn some time, okay? Before you make the payments, right? So that's the idea of preferred stock. Okay? Preferred stock, in many senses, similar to perpetuity, right? Perpetuity. What is a perpetuity? Doesn't matter. Anybody still remember? Yes, this is a type of bond, right? But this bond never pays back the principal, right? Only it just pays the interest forever. In other words, there is no maturity, right? There is no maturity, so there is no maturity payment. They never pay back the principal back, right? But it just makes the interest payments forever, right? That's what we call perpetuity, right? The example was British Consul, right? It's a bond issued by British government, okay? Something like that, right? So the preferred stock is something like this, quite similar to perpetuity, because there is initial investment. I mean, if you purchase a preferred stock, right? So you pay initial price for the preferred stock, right? And then you can expect to receive dividends, right? And this dividend is set. It is constant dividend, right? When the company issues a preferred stock, right? They promise to make certain set amount of dividend every quarter, right? Just like interest payment on a bond, right? And there is no maturity. There is no end. It just goes on, right? So there is, in fact, no difference between the perpetuity and the preferred stock, right? And the last semester, you learned how to evaluate the perpetuity. What's the value of perpetuity? You still remember? What's the present value or value of perpetuity, right? What divided? Huh? Coupon, right, or interest payment divided by interest rate or discount rate. Can't write. Right. Discount rate. Okay? So let's say you receive $1 every, let's say annual coupon, right? Say you receive $1 every year, right? And the discount rate is 10%, right? Then the present value, the value of that bond is what? $10, right? That's how you calculate the present value or value of the bond, right? And that, if you think about it, that makes sense, right? If you invest $10 expecting 10% return, annual return, then every year you expect $1, right? Payment, interest payment, right? So, that can go on forever, right? So, based on that, we have the same idea. The cost of preferred stock can be derived from this equation. The value of a preferred stock should be dividend divided by discount rate. Okay? So the discount rate or the cost of, we're talking about issuing the preferred stock from the company's point of view, right? If you issue a preferred stock, what will be the cost to you, right? The cost will be dividend divided by the price, right? Right? And here the price should be net. What's net? What's the difference between P and P net? What are we talking about? Yeah.
Subtract
issuing cost, right? Because maybe the preferred stock has been sold to the investors at $10, right? But that doesn't mean the entire $10 is received by the company, because there is what? Intermediary, like investment banking firm, right? So that's the idea of spread, right? Investment banker keeps some portion of the proceed, right? So the net, maybe the company receives only $9 out of $10 price. Yeah? Okay, so to the company, if the company pays, say, $1 every year on this preferred stock, right? The cost is 1 out of 9, right? They receive the $9, okay, as a result of issuing the preferred stock, but they have to make $1 payments every year, right? So the cost is 1 divided by 9. That makes sense, right? Okay. Yeah. Any question? Okay. Textbook mentions that in some cases, preferred stocks have maturity. Right? That's weird, isn't it? I mean, if a preferred stock has maturity, I mean, stocks, in essence, do not have maturity. Once you issue the stock, right, it can be sold and resold to another person, right, another investor, whatever in the market, right. The end of the stock will be what? End of the company, right? If the company disappears or goes bankrupt, right, that will be end of the life of the stock, right? But apparently, some companies issue preferred stock with the maturity. Then, if you think about it, that's exactly the same thing as bond. There will be absolutely no difference between the preferred stock with the maturity and the bond, except for that one difference, right? In case you miss the payment, right? Then it will be really terrible, I mean, immediately damaging for the company in case of the bond, right? But in case of the preferred stock, it may be okay to miss the payment, 1 or 2 quarters, right? As long as you can pay back the accumulated the total dividend within short period of time, right? All right, so in case the preferred stock is issued with maturity, right, then in order to come up with the cost of capital, cost of that preferred stock, you can simply use this formula, the bond formula, because in essence they are the same thing, right? There is no difference. Okay? So in other words, you can calculate the internal rate of return using this formula, okay? And you can calculate the cost of preferred stock. All right, what about equity? How do we calculate the cost of equity, right? Well, first of all, let's think about the internal equity. What's the difference between internal equity and external equity? Once again, what are we talking about when we say internal equity? What is an internal equity? Yeah. Retained earnings, right? In other words, you are using this fund, okay? So there will be a cost, right? Think about retained earning. Retained earning should be actually, in principle, should have been distributed to the investors, stockholders, right? In the form of dividend, right? But for some reason, company has retained this earning without distribution to the investors, right? Well, the typical reason is, we expect to need some money next year. We need to, say, build another plant, or we need to replace the assembly line, whatever, right? So we generated, say, $100 million profit this year, right? But we decided to keep $20 million internally and just distribute $80 million to the current stockholders. Okay? That's the idea of internal equity, right? So you're using the fund, and in principle, that should be treated exactly the same thing as raising the fund by selling the stock, okay? Because in essence, that money should have been distributed to the investors, right? But the company has decided to keep the money, right? So you are, in fact, sacrificing rate of return to your investors, rate of return that should have been earned by stockholders, right? You are sacrificing that rate of return by withholding that amount of money as a retained earning, right? So, in other words, what that means is you should have a very good justification. In other words, when you use this retained earning, you have to generate rate of return on that money, right? Because after all, the company is owned by the stockholders. Stockholders are owners of the company, right? And when you sacrifice the money that should have been distributed to stockholders, right? And then you should use that money to generate further profit, right? Rate of return. Okay? So using retained earning is not free. You have to realize that. There is cost of using retained earning, right? So what is the cost of retained earning? Right? Well, in principle, there shouldn't be any difference between the internal equity and external equity, right? What's the cost of external equity? I mean, when you raise the fund by selling stocks, right? You receive the money from selling stocks, but then you have to pay dividend, right? So that's where the cost comes from, right? So there shouldn't be any difference between the internal equity and external equity, except for that little thing, that issuance cost. Okay? So let's say you expect to need $20 million next year. Okay? Then you have two options. Either you distribute all your earnings to stockholders as dividend, right? And then you sell more equity. You sell $20 million worth of new stocks to raise the fund. Okay? That's the external equity case. Or you can retain that $20 million from the current earning, right? In that case, you don't have to sell the new stocks. Okay? But in principle, the cost should be the same, except for that issuance cost, right? Issuance cost. Basically, the money you pay to the investment banker, right, who handles the new issue of the new stocks, additional stocks. Okay? So other than this issuance cost, the cost should be the same between internal equity and external equity. So internal equity, the cost is slightly less than the external equity, right? So what does it lead us to, right? Here's the exact method of coming up with this cost, okay? Calculating the cost of equity. Okay? In previous chapter 7, we learned about the stocks, okay? How to evaluate the present value of the stock or worth of any stock. Okay? And we use the dividend valuation approach. Dividend valuation. Okay? What does that mean? We're talking about this kind of equation, right? If you expect dividend of D1 in the first year, D2 in the second year, and so on, right? Whatever the number of years you expect to hold this stock. Okay? Then you discount all this future cash stream, okay? And at the end, you expect to sell that stock at some point in time, right? So PN is the selling price in case you sell the stock, right? But if you remember our discussion in last semester, this PN, so what determines the price of the stock at that point in time? Yes, sure. The stock price is determined in the market as an interaction between supply and demand, right? But what's the justification if the stock price is $30, right? What's the essential intuitive justification about that for that price, $30? Why would you pay $30 for any stock? Yeah.
It's the value of the company divided by the number of stocks.
Okay. But yes, that's true, but what has it got to do with you? If the company is valuable, what benefit do you derive out of that company's value? Yes?
Expected profit.
Okay, so company makes profit. Do you share that profit? Do you expect to share that profit? Yes, of course, right? So yeah, that's where I'm getting at, right? Yeah, ultimately, the value of the stock comes from dividend, right? So if you go back to my notes, it's from chapter 7, this Pn is nothing but dn plus 1 plus dn plus 2 up to infinity, right? Let me just, okay. So d1, 1 plus k plus d2 divided by 1 plus k dn 1 plus k, and finally we said, well, at this point, nth year, you expect to sell, right? So you discount by the number of years, right? So the story is you expect d1, d2 to dn, right? At this point, you expect to sell, right? But this price, in effect, right, is actually, so Pn, we can rewrite this way. That's dn plus 1 divided by 1 plus k, right? Plus dn plus 2 divided by 1 plus k 2 up to what? D infinity divided by 1 plus k infinity, right? So this price at this point is simply another exactly the same thing, right, for the future, right? Assuming the life of the company goes forever, right? Assuming the company doesn't go bankrupt, right? So that's what, the idea. You have to understand that the value of stock. Value of stock comes from dividend. Okay? Well, you might say some companies never pay dividend, right? Like Microsoft, right? They have never paid any dividend for first 30 years, right? Starting from 1980 to until maybe 2010, right? Still, the stock price was hundreds of dollars, right? So how do you explain that? Company never pays dividend and the price is so high, right? Why would you buy Microsoft stock?
You expect the price to go up.
Okay, so the principle of stock investment is buy low, sell high, right? Everybody knows that, right? But buy low, sell high, right? That's the first thing you learn in investment, right? Of course, if you can do that every time, right, you aren't going to be here, right? You'll be somewhere in South Pacific, sitting on the beach. I won't be here, right? Anyway, so it's called the capital gain, right? You buy the stock at $10 and sell it at $100, right? It's called capital gain, right? So, how do you explain that, right? Well, simple. I mean, when you try to sell that stock at $100, why would anybody buy, or anybody pay $100 for that stock? Are they crazy? Right? What do they see in Microsoft? Why would they pay so much money for the stock for a company, stock of a company? Right. Again, right, that's right. So they are expecting this company to generate a lot of profit. If the company is going to generate any profit, right, then of course nobody will invest, nobody will buy the stock of that company, right? So eventually, what that means is eventually the investors expect to share those profits of the company, right, which is dividend. So, without dividend, there is no value for stocks, right? So this is how we explain the value of any stock, the current price of any stock, right? How it's determined, right? Well, of course, this equation, this formula is useless, pretty much useless, right? Why? Why is it useless? You can't get data? Yeah. In other words, unlike preferred stock, in the case of preferred stock, the dividend is fixed, right? They promise to make certain set amount of dividend every quarter, right? In common stock case, it's not, right? So it's up to company to decide the dividend of every period, right? And they are not obligated to make any payment at all, right? So some companies they skip the dividend for decades, 20 years, 30 years. They never pay any dividend, right? And that's fine, right? So this is simply the concept, right? The intuitive understanding which helps us to justify the price of any investment, stock investment, right? Essence of the stock investment. In practice, in reality, right? This is not very useful. First of all, yes, as you said, the price is determined in the market, right? Well, so we make one assumption here. If we can assume, just like economists, there are lots of jokes about economists. One is 3 guys were stranded in a deserted island. Have you heard of that joke? One guy was physicist, second guy was chemist, and third guy was, of course, economist. Right? And they were hungry, of course, starved. Yeah? But they found out this one can of peach flowing, I guess, shored on the beach, right? So the question, the problem is they didn't have a can opener. So they discussed how to open this can, right? And the physicist goes, well, if we throw this can up to a certain height, right? And when it drops on the stone or rock, right? The force will be just enough to open up the can without, just exploding. The chemist goes, well, if we heat up this can for a certain degree, right, then it's going to open up without exploding, right? Something like that. Right? And the economist goes, what? Let's just assume that we had a can opener. Right? So economists make a lot of unrealistic assumption, right? So here we have an assumption here, right? We have an assumption that the dividend grows at a constant rate of G, right? So we know the current dividend, D0, okay? And if we assume that this dividend will grow at a constant rate, right? Then we can calculate the value of this stock, right? Exactly, right? That formula was what? P0 D1 divided by K minus E. I'm sorry, G. Sorry. G. Right? So the K is the discount rate and G is the rate of growth. Right? So for example, K, so market interest rate is 10%, right? So you are going to discount future cash flows at 10% annual rate, right? But you are assuming the dividend, annual dividend, grows at 5% every year, right? Then you will understand this idea, right? You are discounting all the dividends by K minus G, right? You want to discount it by 10% per year, but the thing is dividend grows at 5% per year, right? So it will be, in fact, discounting at what, 5% annual rate. Okay? That makes sense, right? And obviously, if you think about it, the K has to be larger than G, right? If the discount rate is lower than G, then you won't be able to calculate the current price. Okay? So from that formula, we can rearrange this and come up with the KE is D1 over P plus G. Okay? The cost of equity is, you have to notice that's D1, not D0, right? That's the next year's dividend, right? Not current period. This is period 0, right? So you always calculate the D1, right? And divide by the current price, P0 plus G, right? So when you actually use we're going to do some practice exercise today, right? And you always have to pay attention to that. You have to use D1, okay? So, well, if we know the constant growth rate, if you know that the dividend grows at constant rate, then we can calculate using this formula. Otherwise, it's going to be difficult. So using this formula, if we have this kind of situation, non-constant dividend growth, then we're at the point, we're in the situation where we'll have to calculate this KE using the internal rate of return approach. You can do that using calculator, right? If we know D1, D2, and all the Ds, right? You can calculate the internal rate of return. But the problem is we do not know all this future dividend. Okay? So what do we do in practice? Does that mean that we cannot calculate the cost of equity? Right? In other words, does that mean that there's no way we can calculate the current value of any stock? Well, we do calculate the value of the stock all the time, and you make the decision by looking at the current price of the market value, market price of the stock, and the value of the stock that you calculated. And sometimes they say that this stock is undervalued or this stock is overvalued, right? Something like that, right? Was it yesterday? The Samsung stock went up by, 100,000 won? Something like that, right? Because there was a news that Samsung Electronics, the sales was pretty good during the last quarter, unexpectedly good, right? So, there was a huge movement on the stock price, right? apparently investors decided that current price of Samsung Electronics was undervalued. Okay? So considering this sales performance, right, the market price should have been higher, right? So they have purchased a lot of Samsung stock. Yeah? All right. So how do they know? How do they evaluate? How they assess the value of the stock? Right? Well, there are what we call stock analysts or investment advising firm, right? And they come up with this stock value or fair value of stock all the time, right? And they consider all kinds of factors, right? The sales performance, right? Market condition, economic condition, right? All kinds of factors, right? And then they also look at the past history of the company's performance, company's stock price. Okay? So considering all those factors, they come up with their assessment. Okay? Most famous ones, Zacks earnings estimates. Morningstar Research, and so on. Right? So these analysts always come up with the fair value for the certain stocks, right? They follow, right? And they've been pretty accurate. Their prediction on what's going to happen to the company's profit and dividend, future dividend, right? And as a result of the stock price in the future, right? Have been pretty accurate, right? So apparently there are certain techniques, right, that they can use, right, to analyze available information, past stock price and so on, right, and come up with these estimates or predictions, right? Okay, so that's what we can say about the cost of equity as far as dividend valuation approach goes. Okay. Another approach, of course, is CAPM, capital asset pricing model, right? And here we are paying specific attention to the market risk or systematic risk, right? So considering the systematic risk, which is estimated by beta, right? We can come up with the cost of capital or required rate of return, right, for a particular stock, right? So for any investment or particular equity, let's say XJ, stock J, right? Required rate of return for that particular stock is risk-free rate plus beta for that stock, right? Times what? What do we call that? RM minus RF. Market risk. The difference between the market return and the risk-free return. Okay? So they say historically, based on last 8 decades, about 80 years data, okay, this difference between the market return and risk-free return has been about 8.1%. Okay? So overall, that's just an average of those 80 years. Okay? So there was about 8.1% difference between the market return and risk-free return. Okay? So you can use that and multiply to beta of your stock, okay, and add the risk-free rate, current risk-free rate, okay, and come up with the cost of capital for your equity, okay? Simple. You know that, right? But you have to keep in mind that this CAPM model considers systematic risk only, market risk only, right? So you have to, sometimes you have to also consider this, the specific risk of your company, right? If your company has some business risk, right, which is unique to your company, right, then you have to consider that kind of risk as well. Okay? All right. And then a few other methods. Okay? Risk premium over debt. Okay? Since we're talking about the cost of equity, we're talking about the difference between equity and debt, right? And typically, as we talked about in the beginning of this chapter, yeah, here we go, right? Depending on what types of securities we're talking about, okay? We think there is a difference in the risk level, right? So as a result of difference in risk, we have to have different required rate of return. Okay? Common stock equity is considered most riskiest, right? Equity, the security, right? Compared to that, bonds, debt are considered much safer. Okay? So there is a difference in the market, the amount of interest rate they require, right, or rate of return they require on these two different investments, right? And typically, over the long time, yeah, when they look at the history, yeah, there's about 5.6% difference between debt and equity. Of course, equity is higher, right? Required rate of return is higher on equity, right? Because it is considered much riskier. Okay? So it can be useful as a reference, okay? When you try to come up with cost of equity. I mean, let's say your company currently has outstanding bonds, okay? And you are paying about 3% annual return, annual interest on your bonds, right? And now you're thinking about issuing the stocks, right? Then what will be the cost of raising the fund using that equity, right? So, you know, as a reference, you can say, well, since there is about 5.6% difference, okay, historical difference in the market, right? If we are paying 3% on the bonds, perhaps we should expect about 8.6%, right, cost on equity, right? You understand, right? So you can say that, you can use that number as a reference, okay? But of course, you know, more exact cost. What are we talking about? I mean, you're trying to issue the stock, okay? And you're trying to figure out the cost of equity. Why? Why do you need that cost of equity for? What are you going to do with that 8.6% number? What are you trying to determine here? Yes?
Judge which investments are worth investing or the return you require on your investments.
Yeah, well, the story is you've already determined to issue, you need some additional money, say $200 million, right? And since you've already issued bonds, right, you don't want to accumulate more debt, right? Because debt equity ratio, you're going to mess up the debt equity ratio, right? And if you have too much debt, then it's going to be considered risky by investors, right? So you decided, well, this time we're going to raise $200 million by selling stocks, okay? And now you're trying to come up with this cost of equity. How costly would that be? What are we talking about here? If it was bond, right? You're trying to determine interest that you're going to offer on that bond, right? But you don't pay interest on that bond, on stocks, right? So what are you trying to determine here? Is the question too hard? What are you going to do with that 8.6%? Yes?
No, I wanted that you try to determine the stock price so you get your money, right? Or is the step too much? It's the step before the step you're trying to establish.
Yes, stock price and what? What's the relationship between the stock price and this, say, 8.6%? They think, well, since we are paying 3% on our debt, right? If we issue stocks, our cost will be 8.6%. It has to do with the price, right? But how is it related, the price and the cost of the stock? What else do you need to determine? In other words, dividend, right? Amount of dividend you're going to pay, right? So when you raise $200 million, right? And let's say $200 million, right? And you think, well, about at this time, $10 is about the right price, right? Which means in order to raise $200 million, you need to sell what? About 20 million shares, excluding, I forget about the spread, right? Ignoring the spread, right? 10 times 20 million will be $200 million, okay? So that means, well, okay, I think if we offer the stock at $10 per share, we'll probably be able to sell all 20 million shares and raise $200 million, okay? But where does the cost come into this picture? How does the cost come into this picture?
Yeah, you have to pay all those shareholders.
Pay the dividend, right? Annual dividend, right? So if you're on the annual cost we are talking about is, okay, if we sell the shares at $10 per share, $10 per unit, right? How much dividend we need to pay, right? And there comes the 8.6%, right? So annual cost of what? You sold at $10. So in order to be 8.6%, you need to pay 86 cents per year? If you pay 86 cents per year, right? 0.86 divided by $10, right? That will be about 8.6%, right? Okay. So you get some rough idea, okay? Because according to the history in the market, right? There was about 5.6% difference between the equity and debt, right? And since our own debt, our own bond is paying 3%, right? So from the investor's point of view, or for this kind of company with this kind of risk and this kind of business and this kind of profit, right? About 8.6 is the right return on their stock, right? So you come up with that about amount of dividend you're going to pay, right? Again, this should be just a reference point because exact price and exact amount of dividend, right, should be determined by what? Investment banker, right? Through their analysis, yeah? They're going to analyze all the factors, your company's balance sheet and your past history of the profit and sales and current economic condition and current stock market condition, right? So they're going to analyze all those factors and come up with a suggestion, right? In order to raise $200 million at this point, right? Maybe they say, well, the correct price is about $15 per share, right? And some annual dividend. You have to offer some annual dividend of such certain amount, something like that. Okay? That's what we're talking about as a risk premium over debt. Okay? Stocks that do not pay dividend. If you have a stock that never pays dividends, how do you come up with the cost? In other words, what will be the expected return to your investors, right? Well, if you don't pay any dividend, we have what? No dividend. We have only selling price. Okay? So we're talking about here, right? What will be the selling price at time t, right? At point in time t, right? So you simply discount that selling price by the number of years, right? For the number of years, right? Then you're going to come up with the current value. Okay? So if you want to come up with the cost, right? You have to calculate this internal rate of return here, right? What's the rate of return that equates left-hand side to the right-hand side? So let's say right now the stock price is $10. In the market, the stocks are being sold at $10, right? But I expect to hold it for, say, 5 years, okay? And 5 years, I expect to be able to sell it at $20, something like that, right? So you set $10 for present value and $20 for future value, right? And the T is 5, right? And calculate interest rate, right? That's the internal rate of return calculation, right? And that will be the cost of equity in that case, okay? If the company, stock never pays dividend, okay? Cost of external equity, well, it will be should be exactly the same as internal equity, right? But instead of price, you have to use net price, okay? Considering the issuance cost, okay? So net price will be slightly lower than the actual price, okay? That's the only thing. That's the only difference between internal and external equity. Okay? All right, let's just cover one more slide today. Okay? Divisional cost of capital, it's a very simple idea. It's no complicated concept here, right? But sometimes a company has a few different divisions. Why do they have divisions? It's a quite different situation. Think about GE, General Electric, right? General Electric is not a chaebol. Okay? It's a huge company, but it's quite different from Samsung or Hyundai, right? Samsung and Hyundai have many different business, different types of business, automobile business and all kinds of food business, finance, and just about all kinds of business. Okay, what in Korean we call it 문어발식, as indiscriminatory expansion in just about every type of business. Okay? General Electric is a technology company, right? So they have technology-related business only. Right? Well, they started with the light bulb business, okay? And now they have the airplane engine manufacturing business, diesel locomotive business, the medical equipment business, right? So, there are many divisions, but they are all technology related. Okay? So why do they have different divisions? Why don't they have just one company producing these different products? What kind of risk?
Like, for example, losing money in a division when it affects another division.
Oh, okay. So you're talking about diversification idea, right? Okay. Yeah. Well, to reduce inefficiency. That's the final answer. In other words, to increase efficiency, to maintain efficiency. Because when the company becomes too large, right, it loses efficiency. You should have learned it in microeconomics, right? So in order to maintain the high level of efficiency, you keep each division the separate management. Okay? If the company becomes too large, then you're going to have a lot of levels of management, managerial order, okay? Chain of commands. Okay? And one manager has to oversee too many people, right? So by giving each division a separate management, right, you can keep the efficiency. Right? You can maintain the high efficiency. That's the reason. Okay? So when you have these different divisions, right, it's possible that different divisions have different beta, okay? Or, as he said, the risk, right? Market risk. Right? So how do you apply that idea? I mean, how do you handle that situation? Okay? It's very simple. It's a weighted average. Okay? So you can read this slide. It doesn't say much, right? But if you go back to the chapter, do I have? Yeah. Let's say. Let's say division A, B, C, right? And you have beta, say 1.5, 0.7, and 1.2, right? For each division, right? And here's the weight in terms of amount of total capital, right? Let's say here's 50%, 20%, 30%. Okay? Then the company's overall beta is simply this times this, whatever. If you add them up, that's going to be weighted. That's going to be the overall company beta. Right? Weighted average. So that's summation of beta I times WI. Right? That's all you need to know about this idea. Right? So how do you calculate overall beta? I mean, when you have this separate division. Okay?